It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
And welcome back to another episode of the Real Estate Breakfast, talking your property news 7 days a week, right across this weekend. Yes, into a brand new weekend, a time to put your feet up and relax. Perhaps not if you are chasing the real estate. Good luck if you are heavily involved with that this weekend. It is Saturday, September the 14th. And how are you actually coping right now with your mortgage rate? If you go back to November, December of last year, and the economists were saying right here on the podcast, expect to see, if not in the first quarter of 2024, then in the second quarter, the rate cut by the RBA. It sounded reasonable late last year when we were talking about this. However, there were some economists saying, no, the RBA should not do that in 2024. They should not walk back the cash rate. But if you were holding on to the hope that late last year the rate cut might happen from the RBA this year, you have definitely been left hanging. Although there has been some small shifts from banks, but the real power, of course, the real energy in terms of the rate cut will be driven from the RBA. Let us know if you are making that household budget stack up with your current mortgage right now, as you get set to probably hunker down even further, waiting for relief from the RBA. Let us know. You can email us right here at myrealestatepodcast@gmail.com. So off the back of all of that, and because it is the weekend, a Saturday morning, let's catch up with Anthony Landahl, the Managing Director and Mortgage Broker there at Equilibria Finance. And good morning to you, Anthony. And I guess we should ask you, do you believe that the RBA is on the right path regarding holding off on the rates?
Good morning, Craig. Great to be here, and it's an incredibly topical subject at the moment. There's a lot of pressure from government, from the Treasurer, from a former Treasurer, suggesting the RBA should be lowering the rates. But to be frank, the RBA has got one mechanism, and it's monetary policy. I'm with Michelle Bullock on this one in terms of her handling of the situation and standing strong with the independence of the Reserve Bank. Government should not be getting involved with the Reserve Bank's decision-making and pressuring that. What essentially Michelle Bullock is saying is that we are not out of the woods with inflation. Our target is 2 to 3%. We're still at 3.8%. Unemployment's still running at 4.2%. The target's 5 to 6%. We're well out of our range, and the risk of inflation getting back out of control is a lot more damaging to the economy than what we're going through in terms of holding our nerve through this interest rate period.
There are a number of central banks around the world that have actually lowered the cash rate. People, I think, Anthony, might be sort of struggling to understand all of that. They're saying, hang on, why are other countries lowering, but in Australia, here at home, the rate from the RBA is unchanged? They're confused.
Yeah, well, it's a really good question, and it's a pretty straightforward answer. The first reason is initially those countries, whether it's Canada, US, UK, New Zealand, all increased their cash rate earlier and higher. That's the first reason. So we still have the cash rates in the US, in the UK, New Zealand, and recently Canada until they lowered them. They're still higher than Australia's cash rate. Secondly, the countries that have lowered, let's look at Canada, the UK, New Zealand, they've all had 25 basis point cuts recently. They've all got inflation and unemployment under control. Inflation in Canada is at 2.5%. Inflation in the UK is 2.2%. Inflation in New Zealand is 3.3%. And their unemployment rates are also in their target range. What that's telling us is those countries that are getting their inflation and unemployment under control, the central bank is then willing to look at the cash rate. But until that point, their cash rates have in fact been higher than Australia's. And in fact, the US, the UK and New Zealand's are all still over 5%.
It's also worth mentioning, I think, if you have a look at New Zealand, some of the commentary there, they're not out of the woods by any stretch. They're talking possibly still heading into a bit of a recession, and that could be in the first quarter of next year. The unemployment is going up. So, yes, you can reduce the cash rate, but yes, that whole word, the R letter, still hovering.
Yeah, look, our friends across the ditch certainly aren't out of the woods. I think we'll probably see the New Zealand board decrease that cash rate again in their next meeting. But they have got inflation under control, and they have got the unemployment at a pretty reasonable level in terms of 4.6%. But yeah, there is some concern around their economy, but they went out harder, they went out stronger, and they have got things under control. And you can argue back here in Australia that a lot of households are in recession, and the only thing really propping it up is the levels of migration and government spending, which is not helping inflation.
All right, we are talking all things RBA. Also, you as a mortgage holder, we're going to find out just firsthand from Anthony coming next what is happening around fixed and variable. We'll do that next.
Unlock the secrets of real estate and stay informed about the latest real estate buzz with hot market trends, emerging suburbs, and hidden gems.
And right now it is time for another 30-second property tip. We go to Renee Cross in Elizabeth Bay. Good morning, Renee. What have you got for us this morning?
Yeah, good morning, Craig. How are you? Just thought I'd let you know that, I meet with vendors, every week, and, vendors deliberate in terms of when they're taking their property to the market and what they should do. I always find the vendors that get the best result on a campaign are those that seize the moment. They go with the campaign, they go with the suggestions, they trust the process. The process always delivers, Craig. I see it time and time again. The process delivers.
Why blow your advertising budget on ads people ignore? Connect your business to our niche real estate audience. It's a targeted way to reach the right people. We have over 1,000 episodes on real estate, the largest property podcast library in Australia. Our email address is myrealestatepodcast@gmail.com.
And it is a Real Estate Saturday morning right around Australia as we talk property. And in this case, RBA, the finance rate, of course, what you're paying with your mortgage. And Anthony, as I mentioned at the top about how people are dealing with their finances and paying their mortgage, not an easy situation given that it has been going on for such a long, sustained period of time. People have been challenged, haven't they, to meet the highest interest rates. You are probably seeing firsthand the impact on existing mortgage holders and those seeking new finance.
Yeah, it hasn't been easy, Craig. It is a challenge, notwithstanding my previous comments. A lot of existing mortgage holders have had to rework their budgets. A lot of them are prioritising their mortgages, obviously, and changing their discretionary expenditure. People are selling investment properties when they have an investment as well as a home and focusing on their home because they just can't carry the cash flow needs of an investment. And we are having some people talking to their banks about some hardship provisions through this time. But again, the unemployment rate is quite low. So people are in jobs, people are earning incomes. So there is that factor to it. And people did have good, strong savings and offsets balances coming out of COVID. A lot of mortgage holders are going all right in inverted commas, but not sort of saying it's been a challenge. For new mortgage holders, I guess the main thing we're finding is for those looking at securing finances, the main impact is how much they can borrow. They're already working with and have adjusted to the interest rates. We're assessing their loans at those rates. The main impact is they might only be borrowing 20, 30 or 40% in some cases less than what they could have borrowed 2 or 3 years ago. So they're having to readjust.
As mentioned, the banks, now they've moved on the rates and not waited for the RBA in some situations. And this is a little bit of a confusing part of the market for some people who say, geez, the banks, they never move down their rates unless they find themselves in stiff and real competition. New clients, of course, they're being looked after better with new rates. Nothing new in that. people still want the best rates out there. So what sort of fixed and variable rates are you seeing currently?
Yeah, it's a difficult market at the moment. A lot of the variable rates haven't moved for a while. In fairness, we are seeing a lot of the banks price existing clients and retaining existing clients on the same rates as they're new to bank, which is fantastic. Where we're seeing the main movement is on fixed rates. So what that tells us is some of the providers are thinking over the next 2 or 3 years, we're going to see a rate drop. Interestingly, the main fixed rates we're seeing movement on are the 2 and 3 year fixes. The 1 year fix is still remaining pretty close or even above the variable rate, which might tell us, are they thinking we won't get a rate fall? Will we actually get a rate rise? It mirrors the uncertainty. But where we're seeing the movement in fixed rates is over 2 to 3 years. We're getting some fixed rates around 5.8% now over 2 or 3 years. That's pretty good in the market at the moment, which is 25, 30, 40 basis points less than existing variable rate.
5.8%. A lot of people might be listening to the podcast and saying, really, I can fix my rate across that period of time for 5.8%. I mean, this is the great thing about the podcast, Anthony, is always being informative for people to shop around.
Yeah, well, we can get a Macquarie 2 year fixed at 5.79 with a 70% loan to value ratio. ING's got a 3 year fixed, which is even a little bit lower than that, 5.69%. They're out there, and I think they're going to keep, more providers are going to follow. And we've got access to all of that through our panel of providers. And we're having a lot of conversations with people thinking seriously about locking some of those rates in, give them certainty about their repayments, don't have to watch the news every night worried about what the interest rate and the board's going to do, and manage their budgets accordingly.
I was saying to somebody the other day, just as a result of what has happened with the rising interest rates, of course, from last year, boy, how many people have looked now at fixed rates as opposed to variable rates? A lot of people, I think, have probably done the whole mind shift, wanting to just be more secure in fixed rates.
Yeah, they have. There has been a bit of a shift, but it's only been recently. Fixed rates up until 3-4 weeks ago, virtually, have been above variable rates. So it's really quite a recent shift from the providers and now from mortgage holders to actually seriously start contemplating about fixed rates. A lot of people are still sitting out thinking, look, that's not low enough, those 2 and 3 year fixed rates, but people are starting to think about them. 3 or 4 weeks ago, 5 or 6 weeks ago, it wasn't even on people's radar because there was concern about, are we getting a rate rise? What's happening with inflation? And fixed rates were well and truly above variable rates.
All right, Anthony, a lot there to digest for the listener. You have yourself a fantastic weekend. Enjoy the surf if you're doing that. And thanks for coming on to the Real Estate Breakfast this morning.
No worries at all. Nice to be here, and enjoy your weekends, everybody.
Each week, we bring you in-depth real estate discussions, including inspiring stories from homeowners, knowledgeable real estate professionals and economists. Whether you're a buyer, seller, or just a real estate enthusiast, we are your ultimate property podcast.
1,235,000. Gee, that unit price, Sarah, that's right up there, isn't it, in terms of unit prices across Australia in exclusive areas?
It certainly is, and we're seeing demand for these units actually increase because I guess buyers are moving around into different price categories. So once upon a time it was the first home buyer, but we're now seeing young families looking at units just due to affordability.
And what's been happening with the buyer behaviour in your market?
Buyers are due to the economic conditions, and especially in Brighton, we're seeing a lot of cautiousness enter the market. Due to the fact that prices aren't rising, there's a lack of urgency in the market.
Stay ahead of the competition with the latest news, insights and data analysis on the Property Podcast that keeps you informed. We connect you to the best real estate information across Australia. The Real Estate Podcast.